What if I told you that you don't need to be rich to start investing, and that the biggest lie Wall Street ever sold you is that you do? Right now, with as little as $1, you can own a piece of Apple, Amazon, or the entire US stock market, and the game has never been more tilted in your favor. The old barrier was simple. Brokers charged commissions, minimums were steep, and the whole system was quietly designed to keep regular people out. But something cracked open around 2015 through 2020, when zero commission trading, fractional shares, and robo-advisors basically blew the velvet rope off the front door of the investing club. Here's the part that stings a little. Most people know this now and still don't act. The psychological weight of "I don't have enough yet" keeps millions of people parked on the sidelines while inflation quietly eats their savings like a slow, polite termite. So let's talk about where to actually start, because the account type matters more than the investment at first. Your first move should almost always be opening a tax-advantaged account, a Roth IRA, a traditional IRA, or if your employer offers it, a 401k, especially if there's a match, because a match is literally free money, and turning it down is the financial equivalent of leaving your paycheck on the bus. A Roth IRA is particularly powerful for anyone who expects to earn more in the future than they do today, which, let's be honest, should be all of us. You contribute after-tax dollars now, the money grows completely tax-free, and you pay nothing when you pull it out in retirement. The IRS basically becomes irrelevant, which is a sentence I never thought I'd enjoy saying. Now, once the account is open, the next question is what to put inside it. And this is where most beginners either freeze or get seduced by the wrong thing. Forget trying to pick the next Tesla or timing the market like some kind of financial, psychic, broad market index funds and ETFs are where the quiet, unglamorous wealth actually gets built. An index fund is just a basket that holds a little bit of everything. Think of it like ordering the sampler platter instead of betting the whole dinner on one dish. The S&P 500 index, for example, has returned roughly 10% annually on average over the last century. And you can own a slice of it for an expense ratio as low as 0.03%, which is basically nothing. Now here's where fractional shares change everything for the small investor. Instead of needing over $1,900 to buy a single share of a high-priced stock, you can invest $5, $10, $20, and own a proportional piece. It's like buying one tile instead of the whole mosaic, and you still get to appreciate the painting. If you are the type of person who would rather set it and forget it, and there is absolutely no shame in that, robo-advisors like Betterment or Wealthfront will build you a diversified portfolio, rebalance it automatically, and manage the whole thing for a fee that barely registers. Apps like Acorns take it even further, rounding up your everyday purchases and investing the spare change. So you're essentially investing without even noticing, which is either genius or terrifying, depending on your relationship with your debit card. The real secret weapon, though, the one that sounds boring but is statistically one of the most powerful tools available, is dollar cost averaging. You invest a fixed amount on a regular schedule every week or every month, regardless of whether the market is up or down, which means you automatically buy more shares when prices are low and fewer when they're high, smoothing out the emotional roller coaster into something closer to a gentle escalator. History is very clear that time in the market beats timing the market. The investors who got hurt most weren't the ones who bought at the top. They were the ones who panicked and sold at the bottom. Missing just the 10 best days in the market over a 30-year period can cut your returns nearly in half, which means sometimes the most profitable thing you can do is absolutely nothing. Reinvesting your dividends is another compounding lever that people underestimate because the numbers look small at first, but a dividend reinvestment plan means your earnings buy more shares, which earn more dividends, which buy more shares, in a loop that gets louder and louder over decades, like a financial snowball rolling downhill in slow motion. Keeping your fees low matters just as much. A 1% annual fee versus a 0.1% fee might sound trivial, but over 30 years on a $100,000 portfolio, that difference can cost you over $100,000, which is a whole second portfolio you just handed to someone else. Here's the misconception that needs to be addressed directly. Investing is not gambling. and waiting for the right time is itself the riskiest move of all. Every year you delay is a year of compounding you can never get back. And the market doesn't care about your feelings, your news feed, or whether Mercury's in retrograde. The practical takeaway is almost embarrassingly simple. Open the account today, automate a recurring contribution however small, choose a low-cost total market or S&P 500 index fund, and then get out of your own way. Discipline and consistency will always outperform brilliance and timing. And the investor who contributes $50 a month for 40 years will almost certainly retire wealthier than the one who waited to invest $10,000 at the perfect moment. Position size matters too. Don't let enthusiasm push you into concentrating everything into one bet, even a good one. Diversification is not a lack of conviction. It's the acknowledgement that you're human, the future is uncertain, and spreading your risk is how you stay in the game long enough for compounding to do its job. At the end of the day, the philosophy here is simple. It's not about being the smartest person in the room. It's about being the most consistent one. The market will crash. It will recover. It will make headlines that terrify you and euphoric ones that tempt you. And your only job is to keep contributing and not flinch. You don't need a financial advisor with a mahogany desk and a firm handshake. You need a plan, a low-cost account, and the patience to let time work on your behalf. The barriers are gone, the tools are free, and the only thing standing between you and starting is the decision to actually start. And if you're ready to take the next step beyond investing, whether that's real estate, home contracting, work, or finding the right lenders to grow your wealth, further, check out our links in the description below and let us help you get started.